Welcome to Trading Nation. I'm Sara Eisen. One of Wall Street's biggest bulls just got more bullish, and he joins us now to tell us why. Tony Dwyer is Chief Market Strategist at Canaccord Genuity. Tony, everybody's worried right now about trade wars and Fed rate hikes, and you just upped your price target for the S&P to 3,200. Why?
Right, because, well, Sarah, there's only one thing that really drives the market. The correlation with the direction of earnings is a 0.936. So you only have to figure out which direction earnings are going. And I intentionally waited, Sarah, until early June to increase the number because I want to make sure that the early year economic euphoria didn't fade. And actually, when you look at a lot of the data, such as the CEO survey that CNBC highlighted this morning, the NFIB, which is a small business optimism index, is near a historic high. Consumer sentiment is near a historic high. That doesn't happen when you're right about to tank the economy. And you couple that with the Philly Fed that did a study showing that all 50 states expect growth in the next 6 months. Really hard pressed to say that my new number, which is $160 a share in S&P operating profits, I'm really having a hard time thinking that that's going to be too high.
What about the trade war concerns? I mean, now you're actually seeing it manifest in terms of tariffs from the U.S. toward the U.S. That has to create some business uncertainty.
And that came out of the CEO survey. It definitely creates business uncertainty. But ultimately, listen, I'm the worst at calling the ticks of the market. What I think I've got some degree of history at is using the evidence that presents itself and what it looks like 6 to 12 months out. And while that may give you an opportunity, similar to the Trump election, similar to Italy last week, it could give you an opportunity to have a decline. The question is, what do you do with it with your ultimate expectations? And outside of a recession, when you have an imminent sign of a recession, that is the only time you want to sell weakness in the market. So we just think that there's the fundamental backdrop until well after you invert the yield curve creates an environment ripe with opportunity.
So what does the flat yield curve tell you?
It's funny. I'm glad you said that. Let's say that the worst thing that anybody's predicting right now happens in the next 15 minutes. Let's say that the 2-10 spread yield curve, 2-year to 10-year U.S. Treasury bond yield, that spread, let's say it inverts tomorrow. Then the history shows over the last 7 cycles, you have a median gain of 21% to the peak of the cycle over the next 18 months, and a recession doesn't begin for another 19 months. If you look at the last 3 cycles, Sarah, if the yield curve inverted tomorrow, your median gain is 34% over the next 22 months, with recession not beginning for over 2 years.
My other question is as it relates to earnings and the sustainability of the double-digit earnings growth that we've seen. Clearly, you think that it'll continue to look strong. I'm just wondering, A, how front-loaded those tax cuts really were and how long they're going to help earnings, and B, how much of a tailwind the weaker U.S. dollar is, which has also reversed.
Well, when you look at the weaker U.S. dollar was pretty temporary. We're in the middle of the range of where we've been with the dollar index since 2014. So I think the banter about how we have a hugely strong U.S. dollar, it's basically where it was in 2014. So I think we got to be careful about the impact of that.
Okay.
But when I look at how the data is playing out, you're going to be over 20% earnings growth every quarter this year. So clearly it's more of a 2018 occurrence. But when people say, oh yeah, the tax cuts and the better earnings is discounted in the market, like I said earlier, you'd have to have an economic catastrophe, in my opinion, to make my 160 number wrong. So at the end of the year, if we're at 160 in earnings, you've actually already had the multiple compression. You're at 17 times. You're still nowhere near a recession because the curve hasn't inverted yet. And then you still have 2 years, but you're nowhere near a recession, which means you're up. My assumption, as you know, Sarah, from the note today, is that we're only up 5% in earnings next year, and that gets me to 33.60. That doesn't include record margins and buyback impact.
All right. A bullish call. Thank you for coming here to defend it, Tony.
My pleasure. Thanks, Sarah.
Tony Dwyer. And thank you all for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.